Welcome back, everyone. Let's just jump right into today's explainer. If you're navigating the advanced audit and assurance landscape right now, especially under those ACCA AA standards, you already know that the modern audit is, well, it's definitely no longer a solo mission. Today, we're breaking down the truly fascinating world of collaborative assurance and third-party risk management. We're going to map out exactly how external auditors navigate this incredibly complex web of using the work of others. We're talking everyone from internal teams to highly specialized experts, right down to entire off-site service organizations. Okay, let's dive into this. Think about it. Can an auditor truly verify absolutely everything in a modern, multinational, hyper-complex business? The short answer? No way. And honestly, they really shouldn't even try. Modern businesses operate at such a massive scale that it's physically and intellectually impossible for a single audit team to know every last detail about every single asset or process. That sheer complexity is exactly what creates the need for a collaborative approach to assurance. So here's our roadmap for today. We're going to start with the fundamental need for outside help, then look at how we evaluate internal audit teams. After that, we'll break down the strict rules for relying on outside experts, explore the unique dangers of outsourced operations, and finally, see how all of this impacts our ultimate audit plan. Think of it as a journey of, trust but verify. Section 1. The need for outside help. Why auditors absolutely need backup. In today's environment, bringing in external help isn't a sign of weakness. It's an absolute necessity if you want to gather sufficient, appropriate audit evidence. Now, what's really interesting about this slide is how it breaks down the two distinct categories of others we rely on. First, you've got the expert. This is a highly specialized individual or firm. Think of an asset surveyor valuing a really complex piece of machinery, or maybe an actuary calculating pension liabilities. Then, completely separate from that, you have the service organization. This isn't just someone answering a specific question for you. This is an entire off-site entity handling ongoing operations for your client, like, say, running their whole payroll system. So two very different types of help, which means two very different approaches to verification. Because let's face it, and this is kind of the great irony of our profession, right? Auditors are accounting experts. We're definitely not everything experts. We know financial reporting standards like the back of our hands. But if a client asks us to figure out the remaining useful life of an underwater oil pipeline or the fair value of an unmined diamond reserve, yeah, we've got a massive knowledge gap there. Those gaps are inevitable, and the standard setters totally recognize that we have to rely on specialized pros to fill them. All right, Section 2, evaluating internal audit teams, testing the inside team. Before we even think about looking outside the company, we've got to look at the people closest to the client's own controls. Their internal audit department. But we can't just blindly accept their findings. Under the auditing standards, we have to systematically assess them. Step 1, competence. Are they actually qualified? Do they have the right training? Step 2, objectivity. This is huge. Who do they report to? If the head of internal audit reports directly to the CFO whose numbers they're checking, well, their objectivity is completely shot. They really need to be reporting to the audit committee. And finally, Step 3, audit approach. Is their work properly documented and reviewed? We are legally and ethically bound to assess the client's internal team through these three specific lenses before we can trust a single thing they do. And here's the why this matters factor. If the internal audit team actually passes that rigorous three-step test, it is a total game changer for the external auditor. It means we can strategically adjust our own workload. We can actually place reliance on their testing of internal controls, which, as you can imagine, massively reduces the amount of substantive testing we have to do ourselves. It makes the entire audit vastly more efficient. But again, that's only if that initial evaluation is rock solid. Moving on to Section 3, rules for relying on experts. Trusting the outside specialists. Now we're shifting our focus away from the client's internal team to those highly specialized outside individuals. And this brilliantly illustrates a core debate that pops up a lot, the critical distinction between management's experts and the auditor's experts. So management's experts are hired by the client to help prepare the financial statements, like a valuer hired to price a real estate portfolio. The auditor's expert, on the flip side, is hired directly by the audit firm to independently verify those numbers. The criteria for relying on management's expert is incredibly strict. Why? Because there's an inherent risk of bias there. I mean, they're being paid by the client. When we bring in our own auditor's expert, we have way more control over their scope and independence. But even then, we still have to rigorously evaluate their capabilities and the actual data they use. I literally love this quote because it really hits the nail on the head regarding the somewhat bizarre, recursive nature of our profession. You're an auditor, right? You're trying to verify the balance sheet. But to do that, you end up having to audit the expert who is auditing the asset. You're in there evaluating their qualifications, their methodologies, their assumptions. It's just this endless chain of verification. Just imagine the pressure of this scenario for a second. You're an audit partner, and you're about to sign off on a clean audit opinion for a company that has literally hundreds of millions of dollars tied up in commercial real estate. But you, personally, don't know the first thing about surveying a skyscraper. You are entirely reliant on an asset surveyor's numbers. If their valuation model is flawed or if the data they fed into it is wrong, your audit opinion is wrong. Boom. That's why the vetting process for these experts is not just some administrative checklist, it is an absolutely crucial risk management exercise. You have to understand enough about their work to know if their conclusions actually make logical business sense. Section 4. Risks of outsourced operations, the hidden dangers of third parties. All right, this is where things get even more complex, because we're moving from individual experts to entire operations that have been handed off to third parties. When a client outsources a major function, the audit risks basically multiply. Let's look at payroll as an example. If a client outsources their payroll to a massive third-party service organization, the auditor suddenly loses direct oversight. The calculations, the tax withholdings, the data security, it is all happening on someone else's servers out there. This introduces the very real risk of hidden errors in that third party's internal controls. Honestly, if the service organization's system has a tiny glitch, your client's financial statements are instantly materially misstated. Plus, you've got potential compliance blind spots regarding tax laws or labor regulations to worry about. So, the crucial point is that this loss of direct oversight creates a highly dangerous blind spot in your audit. As an auditor, you can't just walk down the hall and observe the payroll clerk anymore. Those days are gone. Instead, you have to rely on really complex assurance reports, like a Type 1 or Type 2 report, provided by the service organization's own auditors, just to figure out if their control environment is even working. It adds entirely new layers of complexity to the whole risk assessment puzzle. Which brings us to our final section, Section 5, Impact on Audit Planning, Shifting the Audit Risks. So, how do all of these different moving parts actually change the master plan? Well, under ACCA AAA rules, relying on any third party, whether it's the internal audit team saving you some time, an expert valuing a complex asset, or a service organization running the whole payroll, it fundamentally shifts where your audit risks lie. You're basically transferring some of that direct testing risk into reliance risk. If you misjudge the internal auditor's competence, or actually scratch that, if you fail to catch a massive flaw in the asset surveyor's methodology, your overall audit risk skyrockets. Ultimately, it's the danger of getting the final opinion completely disastrously wrong simply because you trusted the wrong person and didn't verify enough. Because at the end of the day, despite the outsourcing, despite the specialized experts, and despite all the hard work of the internal audit team, there is really only one goal: getting that final opinion right. And here is the golden rule you have to remember. The singular responsibility for that final audit opinion rests solely on the shoulders of the external auditor. Period. You absolutely cannot share the blame with the expert or the service organization if things go sideways. At the end of the day, the signature on that audit report is yours. Which leaves us with a fascinating and maybe kind of unsettling thought to close on today. In a world where businesses are aggressively outsourcing more and more of their core operations to these complex, decentralized networks of third parties, who is really auditing the numbers? Are we actually auditing the company itself, or are we just auditing a patchwork quilt of service providers and external experts? It's a fundamental shift in the reality of assurance, and it's exactly why mastering these collaborative risk management standards is just so essential. Keep that question in the back of your mind as you review these standards. Thanks so much for diving into this explainer with me, and keep exploring the incredible intricacies of the modern audit.